Hi guys, welcome to a session of learning with us. My name is Arjit. Today we'll talk about stock market derivatives. If you already have some experience in stock buying and selling in the spot market and you are able to trade in cash individually, this session will give you an introduction to some of the concepts that are related to derivatives and mainly focused on future and options. So what are derivatives in stock market? So if you remember basic calculus from your math class in the school and you remember something of ddx, that value of something dependent on something else, so that concept is kind of similar here. So derivatives are types of complex trading financial instruments which is based on another spot instrument or cash instrument, like it could be a stock, it could be a index, it could be a commodity, currency, or even interest rates. So trading price of this instruments or contract or security, which I am calling as derivatives, are based on an agreement of buyers and sellers for a predefined price and time, and it is based on the underlying or that other stock or the commodity that is based on. Okay, so there could be derivative for individual stock, or it could be a derivative of individual index. So talking about index, it could be for Dow or Nasdaq, or it could be for DAX, or it could be for our Nifty, Bank Nifty. So it could be based on many things like commodities. Also there could be derivative that are based on crude oil or gold or silver, so there could be derivative based on that as well. Okay, so though there are different type of derivatives are available in market, the session's objective is to give an head start in futures and options segment. There are other forms of derivative like currency swaps, but we are not going to cover those. So the derivatives, they are dependent on something, so they cannot exist independently. So the price of the derivative will depend on the something else. So in some case it could be some index, or it could be some stock, or it could be some of the commodities, or it could be some of the currencies. In either way, the security it is based on, so it is derived from, so that security is called underlying. So if I am seeing a derivative which is based on index, so that particular index is the underlying. If I am seeing a derivative based on gold, then gold price is the underlying. Or if you are seeing a price that is based on a currency, so that currency is the underlying. Derivatives also comes with a predefined set of tradable numbers, which means you can only trade in that set, that number, or the multiple of that number, given number. So these tradable numbers for individual derivative security are called a market lot or lot size. So we'll jump more into that with an example, but before that, even though you are actually trading in that big number, so let's say market lot for a derivative, let's say 5,000, if you are trading that big, but you don't have to pay the entire value of the underlying. So if the value of the underlying is 100 rupees and if you're trading in 5,000, so you don't actually have to pay 500,000 or 5 lakhs rupees for it, because market provides you leverage on the margin available for derivatives, which means you can only pay only certain sum amount for trading that particular derivative. In derivative, we also have a concept called expiry and settlement. So previously I mentioned in the definition of derivative that derivatives are sort of contract based on an agreement of buyers and seller for a predefined price and time. So the time is the expiry date. So till that date the derivative is valid, and after that expired date the derivative contract is invalid. So either before the expiry you will have to square off or exit your positions, or your broker might exit on behalf of you. On the other option is that taking a settlement for your derivative on expiry. So basically there could be two type of settlement. There could be a cash settlement or physical settlement. In cash settlement, differences of the derivative and the spot based on your entry, that will be settled either by payable or receivable cash, which means either you are paying or receiving the money directly. In case of physical settlement, you will be receiving the physical version of the underlying, which means in case of stock, you will be receiving the stock in your demat account, or you will be selling your stock from your demat account. In case of commodity, it will be, if it's a physical delivery, you are supposed to take the physical delivery. So which means you are basically buying, if it's an oil contract, you are buying a barrel of oil, you are getting a delivery for a barrel of oil in physical delivery. So that's a physical settlement and a cash settlement. Okay, so let's see some of the stock that is available in India market in our Nifty or Bank Nifty index. So if I go to the official website of India Nifty index, we'll see that the NSE Nifty Stock Exchange India website has a different type of derivatives. They have equity derivatives which are based on equities. So equity derivatives are based on either index, which is Bank Nifty or Nifty, or it could be based on individual stocks. So you can see stock derivatives or the index derivatives in the equity segment. For the currency segment, there are certain set of derivatives are there based on the currency rates, like INR with the dollar, and then British pound with INR, that kind of thing. Similarly, we have commodity derivatives or interest derivatives are available there. Okay, so let's talk about futures. Futures are a type of contract derivative security which are based on, well, quote, future unquote speculation on underlying security, which means there is a future contract based on stock, which means the price of the futures are based on the speculation of the stock. So if the stock is expected to go higher, then there will be more demand on buying futures, and hence the future price may go up. If there is speculation of the stock might go down, then futures will have more selling, and then future price will come down. So that's how the price movement works in futures. So price of the future is basically mimicking the same of the cash security, but except here we are speculating and the price is determined. So future contracts are, since it's same price of the underlying or the spot security, and at the same time we have to trade only in a defined higher number lot size, so which means a small movement in the underlying could result in a bigger changes in your total positions, profit or loss, which means that it is actually high risk high reward security. So you might be losing a lot quickly or you might be gaining a lot quickly. Also there is a term, as you can see, called zero sum game. It's because, like I mentioned before, this future contract is basically created, one future contract is created when a buyers and seller agrees upon a predefined date and time and the price. So which means, so one person is thinking that price of the underlying will go up and one person is thinking the price of the underlying stock or underlying will go down. So the person who is thinking it will go up, he is buying, and the person who is thinking it will go down, he is selling. So based on one buying and one selling, there is one contract created. But at the end of the near expiry, at expiry, the price either goes any of this side. So which means either one of them lose or one of them win. That is why it is called zero sum game. So basically the money is getting transferred from the loser to winner in case of futures. So even the futures mimic the price of the spot. There is a formula based on which we can calculate the actual future price, what is supposed to be. So this is something similar to our one of the other video we spoke about option calculator. So there is a formula based on which future price is calculated, which is like spot price multiplied by this expression, which is basically 1 plus RF into X by 365 minus D. Yeah, this formula looks scary, but it's quite simple actually. The RF is basically rate of risk-free interest. So it's a risk-free interest rate that's similar we discussed in the option calculator, which basically coming from the treasury bill. And so that is RF for, and X is the number of days which is left till expiry. So the contract of the future contract for the August expiry, if there is 20 days left, so 20 will be the value of X, and risk-free interest will be coming from the treasury bill interest rate, and minus D is the dividend yield. So what is the current dividend yield, and is there any other expected amount of dividend is there? So this dividend yield should be considering if there is a pending dividend that is there before the expiry date comes for this contract. So 1 plus risk-free interest into number of days left for expiry divided by 360, this number minus the dividend yield. This whole thing, if you multiply it to the spot price, that will give you the fair price of the future. So even though there is a fair price for the future, the price may fluctuate and there could be some variance in the fair price and the spot market, which means the futures of index, let's say Nifty, and Nifty spot market, there is a difference. That is still possible even after calculating fair future price. Okay, next is open interest and volume. Okay, before jumping into the open interest and volume, since we are discussing about future, let's check some futures in the here. Let's check future for, okay, I am seeing here itself top 20 contract equity derivatives, index option. I will see Nifty 50 futures, and this is August month, is the coming month. 27th August, I said there will be an expiry date. So there is a predefined, the contract will have a predefined time. So the contract for Nifty future expiry date is 27th August. Okay, and there is underlying value which basically defines the price of the spot Nifty value. And Okay, now let's go here. So if I just expand here, if you can see, there is something called market lot. So this is what I was talking about. So you can only trade in 75 quantity or the multiplication of 75. When you're placing order, you have to place the order multiplication of 75. So okay, now is there anything else worth mentioning? No. Okay, now going back to the open interest, because so open interest, so I previously mentioned that a contract is created based on the when a buyer is buying and one seller is selling that contract. That's because unlike stock market, stocks specifically are issued by a company, right? In this case future, there is no issuing organization, so the contract can only be created when somebody is buying, at the same time someone is selling, so that result in a one contract. Now open interest is sum of all total contract which are pending, which have not been squared off and which have not expired or settled. So all the remaining contract that is currently open, so that is called open interest. And future volumes is denoted as total trade executed in a particular period. It has similar implication to that of stock volume, as it provides you insight of the contract liquidity or interest of market participants. Now these two things could be very interesting, and there could be implication of using in a form of indicator or analysis for deducting price movement for the spot market or the underlying, which means I can actually do analysis based on the future open interest and volume of Nifty, and then try to predict what will be the price of the Nifty in the upcoming days, or what kind of movement I can expect. So if you go back here in the open interest, you can see there is something called change in open interest. So it's minus change in open interest, or percentage change in open interest is minus 1.44%. So if you go to some of the tools, this is called Quants app, they also I think have open interest tool for built up, sorry. So this gives a build up of futures, open interest and price, and I think Offstra also has futures open interest. So there is a segment called future build up. So you can see this term long unwinding, short covering. So what are these? Okay, so on the next segment, speaking about Y versus volume of the future. So if there is an increase in open interest and there is an increase in volume at the same time, it confirms what is the current trend is. It confirms it. If there is an increase in open interest and decrease in volume, it says there is a position being built up, either it's a buy or sell side, but the position built up is slow. If there is a decrease in open interest and volume increases, that means people are aggressively squaring off their existing position, either buy or sell. If the open interest decreases, at the same time volume also decreases, that means the security is indecisive and making a range. So in this way, with open interest and volume, you can say what kind of build up happening, or whether people are exiting, or a trend is becoming strong or not, you can deduct from this analysis. Now we'll consider open interest and price. If there is increase in open interest and price also increase, it's said that long build up is happening. That is, a build up of buy positions is happening. If there is increase in open interest and price decreases at the same time, then it is said to be a short build up is happening, which means sell positions is being done in the futures contract. If there is increase in open interest, if there is a decrease in open interest and increase in price, then it said short covering is happening, which means people who already have short positions, they are squaring up their positions, so they are covering their shorts. If there is a decrease in Y and at the same time price is also decreasing, in that case it's called long unwinding is happening, which means people who had long or buy position, they are booking profit. So this interpretation of the YN price and YN volume can help you to deduce the direction of market in form of an alternative analysis. If we head back to one of these tools, so you will see this term called long unwinding. That means some profit booking is happening in this underlying. So SEC is the underlying here, and if you see there is a short covering happening, so there is a open interest change is negative and price change is positive, which is increase in price and decrease in open interest. So there is a short covering happening, so which means people who had short in this, they are booking profit, or they are covering, closing their short, squaring of their short. Similarly, long unwinding, short covering, and there's a long build up is happening, so people are buying this stock. So this, since increase in open interest and increase in price. So this way you can utilize these tools, or if you directly want to check, you can directly check in the NSE website itself to how much price is changing or how much open interest is there, or what's the daily open interest change, and you can try to understand where the market is heading based on this analysis. So what are the practical uses of futures contract? So one usage could be for big capital traders, like let's say I am a big capital trader and I want to trade a very high quantity of a stock. I want to buy a very big quantity of stock, but there is no seller, that big of seller available in the order book. So what I can do in that case, I'll just buy a future and then take a delivery at the expiry, with settling with a physical delivery, and take the stock in my demat account. Or let's say there is, in sudden morning a market crashed very big and there is no liquidity for somebody to buy the stock, so I cannot sell or exit. So what I can do, I can actually sell the future price and then later I can settle with my stocks and exit at that price. So it can use as a liquidation layer when you are trying to exit or enter a big position. It could also be used for a high leverage trading, which means you may not have big money, but you are thinking about making a big profit. You want to take a big risk. You don't care whether you lose all the money, but you want to take big risk with less money. So that kind of scenario, it's a high leverage trading you will be able to use, though this is not a recommended thing. If you are trying to make profit from the market, it is not recommended to try to get big profit with small capital. So you should maintain proper risk reward strategies for trading. Futures can also act as a hedging tool. Let's say you are buying a stock of certain sector or a bank stock, but you are not sure whether there is a certain risk factor might come for banks, or some defaults may happen, or suddenly it may crash. So what you can do, the index of the bank, you can go and short the index and keep it as a hedge to your large quantity of your bank stocks. So even the market crashes, in that case the index also will crash, which in which case it will be protected by your sell positions of the index. So that way you can use as a hedging tool Trend analysis, I already mentioned. You can use the open interest and volume, open interest and price chart that I mentioned in the video to decide what's the current status of the trend and where it is heading. There is something interesting called risk-free arbitrage. This is related to something I mentioned in the formula where I said fair price. So there could be a time due to market volatility, there could be a difference in the future fair price on actual price. So any such differences on future fair price and actual price, you can buy the spot or sell the spot, and then alternative opposite side you can sell the future or buy the future at the same time with equal quantity, and that will lead to a zero risk return. Though these returns are very little and the margin that is required for buying the spot and the future at the same time is bigger, and so return on capital will be very less, but it's a risk-free arbitrage that you can do. So these are some of the use in the futures. We'll continue about more about derivatives and specifically about option in the part 2 of this video. And finally, thank you. Like, comment and subscribe our channel for more such content.